Pattaya City Expats Club is a non-profit social organisation and our speakers are volunteers. The club as such assumes no responsibility or liability for the professional reputation of or the quality of services provided by the speaker today.
We are very blessed. We have established this really great relationship with the club with Business Class Asia. They come, stand up and wave, Business Class Asia people. Come on, Ken Brown and Thomas Carden and stuff. They come down and they're really on top of all things to do with taxation, etc. So we're really grateful that we have this great relationship with them. And for some strange reason, they actually enjoy popping into the meetings when they're here. And Thomas Carden, come up and give us the latest scoops on what the possibilities are with this tax on bringing money from overseas. So here's Thomas Carden.
How much time do I have? Because the possibilities, it would be about 4 days of possibilities and what they're going to do on this. What I will talk about very specifically is what we do know to this. We've talked about this a couple times already, and what we don't know. Okay. The first thing about this is the way taxation has currently been done in Thailand for foreign income. Okay. Under the rules currently, that taxation on foreign income, there was no tax if the money was not remitted into Thailand within 12 months of having been earned. Okay. What that meant was, if you got a pension payment and then the next day you had it wired automatically into here, you were supposed to go to the tax department and pay tax on that income. Okay? Now, practically this was all types of income. But what everybody has said, oh, we had a savings account overseas. We put the money into there, but we took money out of our savings. So you could effectively fill one bucket and take the money out at the same time and consider that your savings. This was a loophole so large you could drive a cruise ship through it. And speculation, no one really knows for sure, is that there's about $6 to $7 billion in liquid assets in the United States alone from Thai investments and families, effectively being free of taxation to this. So one of the points of this, folks, is this isn't really going after you guys. They're going after these wealthy Thai families that have large amounts of money overseas, because most people don't probably realize this, but if you're not a U.S. Resident or citizen and you have a U.S. bank account, you pay no money on the interest that bank account is earning. They also pay no capital gains tax when they sell stock in the United States either. So they had very large tax incentives to be in the U.S. Now, what the rule has changed is it has said that the 12-month rule no longer exists. Just that to it. That's the whole dynamic change of this with it. So any income, theoretically, at any point that gets remitted into Thailand becomes taxable. Do this. Now, they have a huge problem with this because logic starts to come into a couple traps. You inherited a property in 1974, but you've never paid Thai tax on it, but you're bringing that money into Thailand to this. What's the tax going to be on that? No one knows. But there's two specific things they talked about in this. Okay, and these are very important. Okay, the first is the 180-day rule. If you are not in Thailand for more than 180 days, you are temporarily here. Okay, so any money you remit into Thailand would be free of tax because you're not a tax resident in Thailand then. Okay, now I know there's probably some of these. We're in that warmer time of the year coming into it, but a lot of guys here are full-time residents like myself. We don't apply to that rule. Okay. Then we end up into the second rule that it mentioned into the statement with it. And it said taxation or income from a double tax country agreement is exempt from taxation. Now, that's a little bit of a loaded question because the United States, Australia, the UK all have tax treaties. Does that mean that any money coming out of any of those countries would be free of Thai tax? Probably not, because that's the exact type of income they want to go after. What it means is that under the terms of that tax treaty, to this, and each tax treaty is unique, you wouldn't have to pay tax, or you wouldn't have to pay double tax. And let me give you an example of this. If you have U.S.-based Social Security, Article 20 of the United States-Thailand Tax Treaty effectively says Social Security is only taxed in the country that it arises, which means United States. So you got Social Security benefits and you're bringing that money into here to live, you have no taxation on that in Thailand, guaranteed. Now, secondarily to that, there's a double tax agreement in the United States tax treaty and in the UK and the Australian tax treaties. They all have these double tax clauses with us. What that says is, generally, where the country that the income comes from has first right of taxation. So, say you have a business in the United States and you're paying taxes on it and you're bringing that money into here to live off of it. Okay? A little bit rare, but possible. So you make $100,000 and you're paying $35,000 of tax in the United States on that. Now, in Thailand, the tax would be $30,000 on that income. So without a double tax agreement, Thailand could say, okay, yeah, we're still going to tax you at $30,000, even though you've already paid $35,000 tax on this, you lose 65%. You are protected from the tax treaties against this. What it says, all these things say is, the taxes, first, United States has first right of taxation, and Thailand has to give you a credit on your tax paid in the United States. In this particular case, you're going to pay more tax in the United States and owe nothing in Thailand, okay? And you're going to find the same type of clause in almost every country that's got a double tax agreement with us. And there's a lot of these to this. I apologize for the mainland Europeans. I'm not that caught up on the tax treaties with them to this. But you can run this route almost every way with it. So the practicality of this in the end is that more than likely, when this comes into effect, and I do not think this is possible for them to come into effect on January 1st of 2024, you're going to have to end up getting a tax ID number and file some type of Thai tax return with this. The probability of owing any money to the Thai government is actually very slim, but there's probably going to be a compliance thing on this with it. Now, how complex that form's going to be, what the details of that form are going to be, nobody knows. They haven't even announced that that's the rule they're going to go down with this thing. But that's the only practical way they can do this. Now, to go back into the delay again, I joke on a regular basis. I'm actually staying in a mature hotel this particular trip, and I have more probability, in my opinion, of getting struck by lightning twice between walking from here to there than them getting these rules out by January 1st, 2024 to this. The practicality of this is absurdly low. They're going to do that. Now, common sense would say, the Thai government says, we're going to delay this until at least the start of 2025 with this, because they're not going to be able to implement the rules in place with this. Worst case scenario, though, folks, is they don't say anything. You are having to assume that the income you're going to bring in 2024 is going to be taxable because they've never said anything with this. And the wonder goes, are they going to finally issue the rules of what's taxable in July, August, December of next year? You kind of have to live with this a threat or a possibility that they do try to implement something for 2024 to this. But again, the way the rules actually state in this, you should not owe any tax if you're getting this from a European country with this. Now, there are, as this becomes more prevalent in this and the rules get solidified on this, we'll come in on a regular basis. I mean, we came in here, I believe, the Wednesday after this was announced, to this, just to give you guys feedback. We work heavily with your organization. We'll try to keep you guys as up to date as possible on this. But the reality of this is, all we're probably going to see by the end of the year is a delay on this, and that's a hopeful to this. But the idea that you're going to pay a huge amount of Thai tax is also very, very low. It would normally be a situation of where, okay, wait a second, the tax get over there. Because one of the other sides of this too is, what happens if something is not taxed in one country, but it's taxable over here? Most of the double tax agreements say if it's not taxable in the country it originated, it's not taxable in the country in Thailand either to this. And an example of this is Australian superannuitization. A lot of the times, the Aussies, we have any Aussies in the room? Okay, you guys, the good news about that is if you are taking money out of your super, theoretically, the super has already been considered taxed over there and it's not taxable in certain cases. That would not be taxable in Thailand by the dual tax agreements with it. So, but again, to do that, you're going to have to fill out some type of tax return with this. And I can't tell you whether that's going to be a 4-page document or a 40-page document with it. And from our stress, we have a team of 5 Thai accountants who already do Thai tax returns in our firm. But I'm looking at having 25 of these guys to this, and we have to train for rules that we don't even know that exist yet to this. But we're here, we'll help you, we'll keep you guys as informed as possible on what's going on, but there's really not a lot of detail on this, with this. We did a video, again, with Chocolate Man, who's Charles, who's nice here out of Pattaya, and we went for 3.5 hours with speculation questions. If you really want to get into this, it's a great video to watch because it's got a lot of different questions about this. For instance, people who had disability from the military. We got a lot of guys who won that with us from the U.S. Would that be taxable here in Thailand? Fortunately, by a tax treaty, no. And if you really, really want some fun and enjoyment, go read the 68 article tax treaty for the U.S. Thailand. You'll find it's about as clear as mud when you read this stuff, but you can go and look at your tax treaty and get a little more information about this as well. Because, like I said, most countries have a tax treaty already with it. But there's a whole lot still coming on with this. Any questions? Want to do a round of questions? Okay, yeah, again, to reiterate this, U.S. Social Security, by terms of the tax treaty, is only taxable in the United States, period, to it. So you would not pay tax on Social Security that is remitted into Thailand within the calendar year.
Okay, I agree with that. Just a little bit on my background. I'm a CPA retired. I work for the Inspector General's office for a federal cabinet agency.
Yeah.
So I have had some experience reading some of these documents that are as clear as mud.
Yeah.
But I did look at the U.S. tax agreement, double tax treaty with Thailand, and your Article 20, I agree wholly with your interpretation. Article 21, though, as I read it, it says that pensions that are taxed, that derive in the U.S. are not taxable under that tax treaty. So
the pension article is really complex, but it actually does 2 things on it too. It flips government pensions, as yourself, if you're retired from the U.S. government, would be taxable only in the United States, but specifically that's federal government pensions as well. Okay, to this. The regular pensions and other similar remuneration, and including annuities, are only taxable in the state you're resident of. Now, there's a complex bit of this, and we've been using this over the years, to get regular pensions not taxable because the savings clause does not allow that to occur. Sorry for the tax wonk speak, guys. But there's in residence, there's a little bit of a tiebreaker clause in there, because the U.S. Thailand tax treaty is a little bit unique in that both the United States and Thailand reserve the right to ignore most of the tax treaty. But in the residence part, there's a little bit of a tiebreaker clause that says if you're a resident here in Thailand, you get to use the tax treaty. And I'm paraphrasing heavily on this, guys, to this. So you still get to use it. But what this means practically, and we've been using this to an advantage with many people in here, is that you could pull money out of the IRAs or 401ks free of U.S. tax using the tax treaty, okay, as long as it was not a government pension with this. So you could do that, but then that would move the taxation theoretically here to Thailand with this. So if this goes through, it wouldn't be as lucrative because you'd have to start paying tax in Thailand on that pension because Thailand's going to claim that as being taxable. But U.S. Social Security stays taxable only back in the United States and government pensions, which oddly, because the United States, each state is its own sovereign entity as far as the tax system is concerned. So what that means is state pensions and city employees are not a government pension because it only refers to federal government pensions with it. So if you're a state employee, you still have this little bit of an open issue. Now, depending upon your level of planning with this, you could start to begin to daisy chain tax trees though. You could open up through business class Asia. You could open up a pension in Hong Kong, and this is for anyone. Theoretically move the money into your Hong Kong pension for some period of time and move that money back into here free of tax. The advantage of this is, from a U.S. standpoint especially, because you're a resident here, all pensions, regardless of where they are not subject to taxation, blah, blah. But Hong Kong has sole rights to tax pensions between Hong Kong and Thailand. And if you're not resident in Thailand, the tax rate is 0. So only Hong Kong would tax it. They tax it at 0. The Thailand would tax it at 0 as well. So you could, if you've got a substantial amount of assets and you're living off of income here, begin to daisy chain and do planning and move your money that way with tax treaties.
So you said the federal government pensions from the United States are specifically exempted in the treaty, correct?
Yeah.
Okay, retired, U.S. military retired, is that considered a U.S. government?
Yeah.
Okay.
Paid out by the federal government that only stays taxable in the United States.
Excellent, that was my question.
Over here.
Here.
Big George, over here.
Once I went to Chonburi Revenue Department for the tax residence certification.
Yeah.
And I applied it, and I need a tax clearance first, and my income was only 500 and something thousand baht. And then the officer said, no, we cannot give you the certification because your minimum income we expect from you is 600,000. Is this still existing?
Honestly, I can't tell you because most of my clients being U.S. citizens, they don't require that at all. It tends to be some of the European countries.
European, German.
Yeah, German. So you're not having that. But if this goes into place, this is one of the problems with this on January 1st. That rule may have occurred before to this, but it wouldn't make any sense if they're going to make you get a tax ID number. I mean, one of the biggest speculations of this that I have is that when you go to renew any type of retirement visa or even potentially in your 90-day visa, they're going to start issuing you tax ID numbers to this. If you've got any type of visa whatsoever, other than some of the elite visas that allow you that specifically state you're free of taxation with this, they're probably going to start issuing tax ID numbers here at some point in the thing to this, which would effectively become your certification that you're tax resident here in Thailand with it. But not enough rules to tell you if that's going to change or is in place with it on how this is going to work.
Okay, thank you.
Oh, wait for the microphone.
Gotta
We're
wait.
taking the microphones around. If you have a question.
Is it your recommendation that we file a tax return, I guess, in 2025 for 2024?
I would bet that your visas are going to be linked to this, with it. I would bet that you're going to have to file a tax return. If this exists in how they're talking about it, where it is going to go, that there's going to be some type of tax in 2024, you're going to have to file something in 2025. It might be a postcard. I don't know. It could be a 40-page document. But you would, in order to stay here, they're going to require you to file some type of tax return. Unless, and this is a possibility, and again, the possibilities, we could spend 4 days discussing this, unless they say, you're here on a retirement visa, it's a temporary in nature, you are exempt from taxation. This is a possibility, and one of the more higher level probabilities is they just exempt all you guys, and this is an issue. And in that particular case, they may issue you a tax ID number and say, you just fill out a card and say, I'm on a retirement visa with it.
All right, one other question. Let's say you have $100,000 in the United States and you get income on it of, let's say, $10,000. You bring the $110,000 over here, are you just taxed on the $10,000 or are you just taxed on the $110,000?
What you'd be talking about, okay, there's two different issues here, two different ways they do this. Okay, the one is called a remittance basis of taxation. Remittance basis is where they tax everything that comes into the country, and then you have to prove what tax you've paid that in the past. So if you have no ability to say this money was taxed at some point in the past, you'd have to pay tax on this. No one really knows how to do it, and practicality of that is very, very difficult. But structurally, you're supposed to only pay tax on the $10,000 of income to it, not your principal, but you'd have to justify how much tax is paid on that. Which, you know, for our firms, and we've got several large Thai accounting firms that have started to come into my firm now because they're concerned that they don't know how U.S. income is taxed. So they've got all these people with investments over there. They're coming to us to consult with how much tax would be paid if the money comes into it. So in a way, you've got the largest accounting firms in Thailand asking that exact same question. No one knows specifically yet. Can they do it in a variety of different ways? Yes. In my opinion, the way they have talked about doing this is fundamentally broken. What they have to do is they have to reform from a halfway system of feet in all these different camps to a true regular global taxation system. What a global taxation system says is, and this is the way it is in Australia, New Zealand, Germany, the US, when you are resident in that country for the 181 days, you're taxed upon your global income to this. Everywhere in the world it's earned, you're taxed on it, but you get tax credits for the taxes paid in other countries to this. And again, so you're not getting double taxation, you're just, if you've got a UK investment and you're a US citizen and the UK taxes that at 40% and the US taxes it at 35%, you're gonna pay the 40% tax, but you're gonna pay nothing in the United States. So you're not gonna get double taxed on, for most people in this room. It's just a matter of the computations and exactly how they manipulate that are up in the air. But really, they need to reform the entire system. And that's gonna take several years to do with it. It seemed, in my opinion, the minister who came up with this thought this was an easy way to close a loophole and pay for the 10,000 baht for everybody, and it's come down on them hard. This is a nightmare of amount of regulations that need to be rewritten and reformed in how these guys tax it.
You mentioning the different visas. What about resident visa?
Yeah, if you're going to be totally taxed in the U.S. On your income remitted into it. So, yeah, if you've got a resident visa here in Thailand, yes, you'd be subject to these rules. You're more than 180 days a year, you'd be subject to them. This again, this was mostly meant to go after Thai citizens who have money overseas.
For U.S. Social Security, to be exempt, does it need to be deposited directly into a Thai bank account?
Not at all. You can send it through. You can, excuse me, as long as you can justify that that money comes in as Social Security and that's the money you're bringing in, it will be exempt.
And can you avert the 180 days by just doing a border run every 179 days?
No, it's 180 days in the calendar year. So you can't skip out and say it's not continuous. It's 180 days during that year.
Over here.
I'm in the process of selling my home, and normally, I believe, correct me if I'm wrong, that if this would be the first time I would sell it and not buy another home,
Yeah.
and I would normally get an exemption on taxes on that. Would that exemption keep it from being taxed in Thailand under these new rules, or not?
Honestly, difficult to say, because what you theoretically have is you have, if you've lived in it 2 of the last 5 years and you're single, you have a $250,000 exemption. If you're married, you have a $500,000 exemption. So theoretically, yes, that $500,000 of potential gain could be free of tax here with it. Oddly, the UK tax treaty is slightly stronger about that than the US side, so they could potentially go after that gain with it, but yeah, doubtful.
As you know, in the United States, long-term capital gains are taxed at a lower rate than ordinary income.
Yeah.
So supposing someone has long-term capital gains, they're taxed at, let's say, 15% in the United States, but the tax rate on income in Thailand is 30% or 40%. Would there be an exposure on those long-term capital gains?
I believe, and I'm unfortunately not the exact expert in this. I have a little Thai Laotian lady named Gal who does this, but I believe, here's the good news, I believe it's 10% tax in Thailand. But yes, what happens here, especially as a US citizen, you're kind of used to this in every other country, what you always end up paying is the higher tax rate and wherever your investment or you are to this. So if your income, if you're in the UK, you pay no US tax because tax rates are higher in the UK than they are in the US. But if you go to Dubai and there's no tax rate in Dubai at all, you can use the foreign earned income exclusion, but you're going to end up paying the higher tax rate in the United States to it. So whichever does work out, but in most cases, the US is going to tax you higher than Thailand does to this. The one exception to this is very high wage earners. There's a little bit of a window there between the 39.5% tax rate and the 37% tax rate in the United States. And Thailand hits that max tax rate just a little bit more. But even then, the taxes are a couple $1,000s in Thailand. I have clients who literally make $1 million a year as executives in Bangkok, and their U.S. tax liability is generally only a couple $1,000s because the Thai tax rates are right there with them.
Over to your left.
Coming back to Hong Kong, your question about Hong Kong. I have a residency certificate of Hong Kong. I have my capital in Hong Kong. I don't live over 20 days in Hong Kong, so I'm not taxable. What happens to me in Thailand?
I'd have to go, if the money is not in a pension situation, yeah, if it's a regular account, you could theoretically, you would be taxed here. You would need to move the money into a pension to be free of the tax liability here to this. So if you...
I would have to move my money in Hong Kong into a pension scheme.
It could be a Hong Kong pension scheme. In fact, that's exactly what you want it to be. So you'd move it out of a regular account and shift it into a some type of Hong Kong pension system, and then that would allow you to pull the money out free of tax.
Otherwise, I would be taxable here
Otherwise,
in
you'd be
Thailand.
taxable here, yes.
Okay, thank you very much.
And you guys can help with that, right, Thomas?
Yes. Well,
You
actually,
can help set up pension
Lee
fund?
and Ken. By the way, we are two different companies. I'm the director of American International Tax Advisors. Business Class Asia handles the financial planning and actual allows you to do planning. And we work together for a long period of time. to find the solutions, because I always describe the situation of an off-center clock, okay? Does anybody know what the difference between a meat grinder and a clock is? Okay, in a meat grinder, the gears are slightly off-center, and the meat goes through and you come out sausage. In a clock, the gears are all together, and you get to dinner with, you have a steak dinner instead. You know, international taxation works a whole lot like that, in that if you get it slightly incorrect, you come out hamburger at the end. But if you get it correct, you can have a steak dinner.
Do you know if Canada has a tax treaty with Thailand?
I believe so, but I have not had time to review it yet. You're going to find most Western nations, and I would almost guarantee that everybody in here, with the exception of our beautiful lady from Trinidad, has a tax treaty. You know, with it.
Hi, I've got a question. I can bring in a lot of money from an ATM fairly easily. How does that fit in? There's no way they can track it.
Actually, yes, they could theoretically track it, because the banking system here would be able to track that credit card. By a computer logarithm, they could say that credit card has been used at the ATM so many months. They could shut the credit card down, shut the ATM down with it. Fundamentally, if you try to, I'm not going to say cheat the system, but avoid the system doing that, most countries, the term for it is called structuring, and that would be a felony in the United States if you're trying to structure your transactions in a way to avoid the reporting regulations. I would bet something like that will come into place. If these people start to use their credit cards that way, and it's more than what a tourist would do, they'll start locking the credit cards down out of the banking system here. That sounds like it's incredibly difficult to do, but that'd actually be very, very easy to do to the banking system with it. But there's always going to be marginal things you can do. If you do regularly pull out, 4,000 baht out of the ATM, I don't think anybody's really going to bother you. But if you're pulling out 100,000 baht a month out of different ATMs, they're probably going to come after you at some point.
So if you have a savings account here in Thailand, let's say it's earning maybe 2%, what's the tax rate going to be on the 2%?
Within a point or two of what the United States is. I actually have it on my phone. I have the different brackets to it with it. So it's what happens in Thailand is you hit the rate slightly earlier than you do in the United States, but it's a progressive rate, 10, 15, 20, 25% to it. But, based upon that.
Yeah, hi. Are you aware of the automatic exchange of information on tax matters, where the countries amongst themselves provide information on accounts, type of accounts,
common reporting
balances,
standard.
and interest? Thailand so far, at least this year, is not yet participating. What's your outlook on this with regards to Thailand?
They actually, you've not quite come up to date on that. I believe a month or so they joined the OECD's common reporting standard. That was theoretically part of the trigger of this. What he's talking about is banking information which generally not shared between countries to this. Around 2011, FATCA, the Foreign Account Tax Compliant Act, passed in the United States, which forced all countries to share banking information on U.S. citizens and green card holders back to the United States. The rest of the world seemed to like that a whole lot, and they started a system called Common Reporting Standard, which has a lot of the same things. Thailand had not shared that information, and it's signed up for that until very, very recently. They've joined this, which means that they're going to be able to, they're going to be able to look in and see what you would have in England if you are tax resident here, or the UK or Germany, any of these common reporting standard countries. They've already signed a bilateral information sharing agreement with the United States. So they've already had this in place with the United States. The Thai government could see what was in the United States for Thai account holders with this. So.
Hi, I've got two questions. Do you have a point of view yet on what, if anything, the impact of this is going to have on the U.S. earned income exclusion? And I assume maybe some other countries have equivalent or similar earned income exclusions?
That's actually very rare. Most countries, when you are living overseas, do not tax you. When you're not resident in that country, they don't tax you. In fact, only the United States and Eritrea tax you on your global income when you're living outside the country with this. And Eritrea is mostly known for going to war with Ethiopia on a regular basis too.
Right.
So it's rather rare that you have to fill out a tax return back to your home country when you've been outside of it for 15 years. That's a unique part of the United States. Whether or not your income is coming out of the United States, you got to file these tax returns to this.
But I'm saying that you don't have a point of view yet on how it's going to be.
The FEIE is fundamental to U.S. law. It would have the Thai tax change would have no effect on the U.S. how the U.S. changes everything.
Okay, so
none.
You still have the earned tax exclusion, but you might wind up paying taxes.
Yeah.
Okay.
Yeah.
Okay,
yeah.
that's the worst.
And what happens is, okay, again, let me explain this a little bit. If you are earning income or wages in the United States, okay, and you are outside the country for the entire 12-month period, except for 30 days, you can go back in for 30 days, you're able to exclude that income up to currently $112,500. Next year to be $120,000. But that income is not investment income. That income has to be self-employment or wages to this. Now, from looking at everybody's hair color here, I'm assuming that most people are retired to this, so it's not really used here. But in Dubai or the Middle East, I was just there at the beginning of the month. I've spoken both Dubai and Saudi Arabia. Those guys are all earning wages. They use the foreign earned income exclusion because there's no taxation on income in Dubai and Saudi Arabia to this. But the exact polar opposite is the United Kingdom. If your American is living in England, their tax rates are higher than what they are in the United States, which means you never use the foreign earned income exclusion, you only use the foreign tax credit.
Right.
Part of this as an American is like a ballet dance of what is where and how you plan on this.
Right. Okay, and this again, this is just probably more of a compliance issue than a real money issue. But on credit cards, they can see what's a purchase versus when you're using the credit card to take money out. Are they going to regard purchases as a remittance? I mean, that's
no way to know.
Okay.
No way to know. My speculation on that, and this is total speculation, the easiest thing to do for them is to track a credit card as it goes through the banking system. To this, they put in a logarithm and say that credit card has been used for more than 6 months. Here, that person is clearly resident here in Thailand, and they would lock the credit card down to it, unless it's been in some way reported to them. That would be the easiest thing for them to do. But do they sit there and go purchases versus this? Do they sit there and say 5,000 baht limit or 50,000 baht limit on ATMs over the month? No way to know. There's no guidance whatsoever in that.
Okay. I just wanted to briefly, before Thomas finished, because I know Thomas answered a lot of questions, wanted Lee and I to come up. I was recruited, Thomas met our CEO, explained all the issues, like these issues are changing now. So basically our CEO came up with solutions just for Americans. They recruited me from Abu Dhabi to come here and work. My colleague Lee, he's from the UK. So basically, all these things we're saying, we have solutions, for these type of things that happen. So we talk about the Hong Kong pension and those, I don't want to get too detailed in this stuff, but as things come out and change, we're here to accommodate, the issues to, protect or, to take care of you moving money in and outside. And we also don't necessarily recommend keeping that much money here. Our solutions aren't here. So we try to figure out the best way going forward. If so if you can plan going forward with those kind of things with the Hong Kong pension and right now. So if you had assets somewhere and they say the Hong Kong's tax treaty will work like that, then everybody could just move their money to Hong Kong inside a pension, problem solved, through that tax treaty, the dual tax agreement. So for Americans, we have all kinds of solutions. We've been reporting and explaining how anytime we open an account, we have to explain where that money came from, how you earned it, things like that. So don't get too worried about we can't prove it's from Social Security or things like that. You got a benefits letter. We can see the same amount going in. There's ways to prove these things. So just wanted to, again, Thomas does the taxes. We will accommodate with solutions as we know what we need to handle and things like that.
We're gonna be out here afterwards too for a few minutes, as well. So if any more questions, I think we're running low on time, to it. So we'll do more questions.
Can I just say something? In terms of the Hong Kong pension schemes, if you were Brit, if you're a different nationality, they were really good before this new tax come out. From a UK perspective, they take it out of inheritance tax, they take it out of probate, they take it away from creditors, and then the income can be taken either back to the UK or to Thailand free from tax. Now, with the new announcement from the Thai government, us Brits have had it kind of easy over here for many, many years. Our American cousins have to report every year anyway. The Brits, we were just left alone. And now we potentially have to report. So what that does is it makes our pension scheme in Hong Kong a little bit more attractive than it was before, and it was very attractive before from a tax perspective anyway. Within the trust, you can hold all sorts of different options that you select. So it can be cash, it can be shares, it can be income-paying investments, whatever it is that you want to do, you place in the trust. But whatever you place in there becomes very tax efficient for Brits when you die, when you're passing it on to your beneficiaries, and now it could prevent you from paying tax in Thailand as well.
Would that include crypto?
You can include some kind of crypto. There's a couple of ETF funds out which do Bitcoin. So I think BlackRock's just bought one out. There's a couple of others. Some investment platforms that we put within the trust will allow crypto investment. So if that's what you're looking for, then we would build it in such a way that you could put crypto in. But crypto being crypto is doing kind of nicely at the moment. Yeah, it's looking like a better option than it did before.
Really quickly, we learn each other's issues and problems. For the UK, everybody from the UK, you need to have a conversation with Lee. And the reason I say that is that as Americans, we're taxed up front. You guys are taxed on the back. When you die, they tax your estates. If you have something in the States, you think it's okay, your domicile, and then your family ends up getting taxed like crazy. So just not to go deep into that, talk to Lee about this stuff because these are real issues. They're going to get your money after you guys pass away. Your family's got to, they only have like 6 months to liquidate it anyway.
Yeah, so
just have a conversation with them.
Yeah, you got 6 months to pay. And basically, if you look at the inheritance tax in the UK, it's gone from like £2 billion a year, maybe 10 years ago. Now it's 8 billion, right? And the average property price in the UK now, just under 300,000. Okay, if you're single, you get an allowance of 325. So you start building cars, furniture in. The average person now is paying death duties. Before it was seen to be a rich person's tax. Okay, but they've built it in such a way that they're actually bringing more and more people into it. And I don't know if you've seen the news in the UK recently, because they're freezing personal allowances, basically your state pension will cover your full personal allowance, and anything you earn in addition is going to be taxed. And even a part of your state pension now is likely to be taxed because they're not increasing the allowances. And that's the same for inheritance tax. If you don't increase the allowance, and your house is going up by 10% a year, well, very soon you pay tax when you didn't before. So it's not just rich people that need to plan. It's just the average person now.
You don't want to be in the meat grinder.
Okay.
Yeah. Thanks, Rick.
Thanks, Ken and Lee. And a huge round of applause, especially for Thomas here. Thank you, mate. So stay here. We have a very small token of our appreciation. I have a feeling he'll be back in the not too far distant future giving us an update. But thank you for that.